Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Cut to the Chase. Now yesterday proved to be a day for markets to take a bit of a pause amid what was a small flood of macroeconomic data and events. Asian markets were up strongly as they caught up with improved sentiment over the prior day, but both European and US equity markets were largely flat while bond yields and the US dollar retreated slightly. Now, the main event was the release of the minutes of the last Fed meeting in January. These meeting minutes showed, unsurprisingly, that policymakers were quite focused on inflation risks, noting price increases had been stronger and more persistent than they'd anticipated. The minutes also showed Fed members believed a faster pace of tightening was warranted compared to the last cycle, though that was when the Fed waited about a year between the first and second rate hikes in 2015 to 2016, but also they discussed how balance sheet reduction could occur. Now, for markets, the minutes were received almost with a sense of relief, with the minutes appearing at least no more hawkish than what's already priced in. We thought it was interesting that market pricing of Fed rate hikes actually reduced slightly to about 6 rate hikes for 2022 from about 6.5 before the minutes, and that both the US dollar and US bond yields actually eased slightly. Having said that, we'd caution the Fed debate may not be completely over, given we have about a month to go till the Fed policy meeting in mid-March. It does suggest, however, that incoming policymaker comments may surprise markets less than in recent weeks if they are consistent with the minutes. Now that's in the US, but looking beyond the Fed minutes for a moment, there was a mix of good and bad news in other regions. In Asia, it was mostly good news. That was led by China's producer price inflation coming in below market expectations to the slowest pace in 6 months. Now, this arguably creates that much more room for the central bank to consider easing policy, which is important because this is one factor we've laid out before as a potential catalyst for our preferred Asia dollar bonds and our preferred equity sectors, industrial and consumer discretionary in China. Now, elsewhere, South Korea also reported the highest job creation number in almost 22 years, while Singapore reported 7.6% GDP growth for 2021. Now, while both these numbers were optically lifted by a low sort of statistical base after the pandemic, they both undoubtedly lifted sentiment. I mean, recall that on a 6 to 12-month horizon, we view both the Korean won and Singapore dollar as preferred, given their economies and asset markets tend to be correlated with the global cyclical economic recovery. Now that's in Asia, but in Europe, though, there was still bad news, particularly on the geopolitical front. Despite Russian reports of the withdrawal of some military units, NATO said they'd seen no de-escalation and that Russian troop numbers were still rising at the Ukraine border. Now for markets, no surprise, this renewed support for oil and gold prices, at least overnight. But for the financial market specifically, given oil is still very much in focus as a possible market implication of the geopolitical crisis, we thought it was a good time to remind listeners that the Canadian dollar remains one of our preferred currencies. It can offer one hedge against any unexpected move in oil prices, given its correlation with energy, but it's also likely to see support from the Bank of Canada, with Deputy Governor Lane recently saying that the central bank was going to be nimble and potentially forceful in tackling inflation. So, a busy macroeconomic day, but a few sort of currency ideas that we think are takeaways from that. But before I end, just a reminder that it's almost the end of the week, and it's a reminder that Steve is back with a Through the Noise podcast tomorrow, where we'll step back and look at some of this week's development in the context of a somewhat longer-term perspective. So please do keep a watch out for that. With that, we'll sort of end the podcast here. Once again, if you enjoyed the podcast, please don't forget to rate and like it. Thanks again for listening and wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.